Hi everyone, let me briefly introduce myself. I am Alvin, the research analyst from FSMOne research team. Before starting, I would like to thank you all for taking your time off your busy schedule today to join us here. So let's not waste any time and start our session. So for investors who have been with us quite some time, I know that all of you were pretty familiar with China, as we have been keep talking about it since last year. So in 2022, there has been no shortages of headwinds facing China's economy, with a lot of negativities already priced in the market. A further easing of regulatory pressures and policy backdrop that still remains accommodative means that there is scope for Chinese equities to outperform. So today I'll be sharing some updates on China market and reiterate our bullish call on the Chinese equities. So without any further ado, let's start our session. So from this chart that you are now currently seeing are some of the stock market under our coverage. The year-to-date performance shows that most of the regional markets are still in negative territory, while the markets that fall in the positive territory are mostly from the Asia region, such as Indonesia, Singapore, Thailand, and Malaysia. If you do keep an eye on the Chinese equities, you may notice that the Chinese stock market has had a decent rebound back in June. However, after all the events such as the revival of COVID-19 cases that caused even more lockdowns, a weaker growth guidance by the government, and also the worsening of the property sector, the strong rebound has fizzled out just as quickly as it began, with Chinese equities plunging to around 20% as of the 1st of September, becoming one of the worst performing equity market so far in 2022. So despite the sharp sell-off since our last update, we remain convicted to our investment case for China. So diving into the sectors for CSI 300 index, we will notice that there is a dispersion between in the positive territory for the year-to-date performance as well as the one-month performance. So on the year-to-date performance, all sectors are in a negative price return, except for the energy sector that benefited from the higher commodity prices. The Chinese technology sector is still the biggest loser in the year-to-date performance. So moving on to the one-month performance, we see that more and more sectors coming into the positive territory, such as the utilities, financials, and telecom. So also we will notice that technology index is not one of the worst performings anymore, as they have as materials, industrial, and consumer discretionary are recorded more worse return than them. So one question that investors might have in their mind is that, is China in a recession? Before we come to a conclusion for that, let us take a look at some of the economic indicators. First, the China manufacturing PMI is a very important indicator that affect business and also suppliers' production decision. From here, we can see that there is an uptick in the China manufacturing PMI for August, as shown in the blue line, but it is still below the boom or bust line that separates expansion and contraction. So nonetheless, it still shows a recovery despite not COVID-19 heat waves due to the expansion in consumer goods production. Meanwhile, non-manufacturing PMI, as represented by the orange line, contracted but remained in a relatively high expansion zone due to the impact of new lockdowns and high temperatures. So the chart on your right-hand side shows that while public investment on fixed asset has increased considerably, as shown in the orange line, the private fixed investment on fixed assets still remains low. This creates a mismatch. From January to May, the Chinese government has approved a total of 48 fixed asset investment projects that worth a total of 650 billion yuan. As you can see, there is a huge V-shaped rebound at the start of 2022, showing signs that the Chinese government is not holding back on their initiatives to get the economy back on track. However, we can also see that the private investments at the meantime still lag, showing that there's low confidence in the market. So how bad is the consumer sentiment in China? The private consumption stood about like 38.5% of the nominal GDP in 2021, with an average share of about 50% from 1952 to 2021. So however, the consumption contribution towards the share of GDP has experienced a steep slump since the issue of the mortgage boycott to a negative of 200% from where it was previously. So from the other chart on the right hand side, you can see that China's GDP in the latest quarter is 0.4%, and the less satisfying GDP growth signaled that the economic growth target of 5.5% is increasingly challenging. But China is still on track on achieving a GDP growth of 3% to 3.2%. So the weaker growth guidance for the GDP growth has worried investors around the world, and China is in their inevitable slowdown. But I don't think that this is not something to be frightened about, as you can see that US here is already in 2 consecutive quarters of negative GDP growth, and they are not considered to be in a real recession yet. So while China has yet to even step into the negative territory. So from this chart, you can see that although so far China has been surrounded by ominous dark clouds, we're still seeing some green shoots in the deserts that as a sign that things aren't so bad at all. First, China's unemployment rate stumbles to 5.4% since its peak in April. It was the lowest jobless rate since January, and the continued efforts by the government to revive the momentum of the economic recovery by further loosening its COVID-19 restrictions. So furthermore, with a larger and a richer consumer group, China's market has expanded its charm towards the global companies as they have boosted their presence to meet Chinese consumers' demand over the past decade. So in the 2 years starting from the pandemic, China has surpassed US in terms of annual retail sales, becoming the world's largest consumer market thanks to their large online retail sales market. So a weaker Chinese currency and rising prices of its export helped to boost China's trade balance. July's strong export performance sent China's trade surplus to a record of 101 billion for the month. This is the first time the economy has surpassed the 100 billion threshold. So China's surprisingly strong export growth in July lifted its trade surplus to another record and provided some much needed economic support. But we think that the country will still need to find its ways to keep its fragile recovery on track as the global economy slows down this year. Moreover, China's inflation rate is still remain modest, allowing more accommodative policy measures. As shown in the chart, China's inflation rate is around 2.7%. In July, although the inflation rate has risen to a 2-year high on the back of higher food prices, especially for the prices of swines, it is still low compared to other developed countries such as Europe and US, who are 8.9% and 8.5% respectively in July. So our conviction towards Chinese equity stems partly from the country's policy backdrop that still remains accommodative relative to the developed world. As shown in the table, China has been ramping up efforts throughout 2022 to revive its economy and boost market confidence. This includes interest rate cuts, issuance of special bonds for infrastructure investments, tax rebates, and also a cut in vehicle taxes. So more recently, we can see that the PBOC has responded to the weaker economic data with a surprise interest rate cuts, lowering the rate of its 1-year policy loan by 10 basis points, and the 7-day reverse repo rate also by 10 basis points from 2.1% to 2%. And also the 1-year and 5-year loan prime rate has been cut. The 5-year LPR, which was last lowered in May, influenced the prices of the home mortgages. So with all of this supportive policy in line, we think that China is actually playing a waiting game for the economy to rebound. So, however, positive reactions to the rate changes were short-lived, as fresh monetary stimulus was seen as fertile as flogging a dead horse, given that China's economy desperately needs consumers back on street spending money. Um, the latest round of cuts towards a 5-year LPR hinted that the seriousness of the property market downturn has gone way beyond expectation of the Chinese authorities. So with property accounting for around 15 to 30% of the China's GDP, the market will spell trouble towards the world's second largest economy and potentially the global growth as well. So we think that these cuts wouldn't be enough to increase liquidity as shown in the chart here. The China Consumer Confidence Index is already at record low, which sends a strong message that policymakers need to be more willingly to take more forceful actions to stabilize the ailing market. So as mentioned, one of the major contributions towards the low consumer confidence was nonetheless from the Chinese property crisis. News of Chinese home buyers threatening to stop their mortgage payments was splashed across headlines over the past few months. This came across as financial distressed developers face difficulties in delivering their home that has been pre-sold. So the mortgage boycott has spread from just 30 projects to around 300, and now I think nearly 400 projects just in a span of few months, leading to some belief that the situation might get out of control. As shown in the chart on the left-hand side, the bond of Chinese developers extended their losses, and even some of the investment-grade developers with strong financial standings have taken a beating. So what exactly went wrong here is that selling new homes before completion is a very common practice in China, and also Malaysia is also adopting this practice. So why were home buyers willing to pay in advance for a home that hasn't been completed yet? So, well, for the reason is for the longest time, China's property market was red hot. As shown in the chart on your right-hand side, property prices have steadily increased, experiencing positive change on a month-to-month basis. As you can see, most of the before this situation happened, China's property has been on the positive side, which shows growth, and then people think that prices could only go one way up. So prospective home buyers were inclined to prepay as they were concerned that prices will continue to rise again. Although developers were bringing in a lot of revenue from pre-sold homes, they were also incurring a large amount of debts. So as restriction on property sector intensifies, developers, particularly those with weaker financial standing, struggles to obtain financing. So some eventually they face liquidity crunch with insufficient cash to pay for the ongoing construction of their projects, and subsequently they fail to deliver their pre-sold homes in a timely manner. So coming to the question that why home buyers are boycotting mortgage payments is that, let's take a look at the graph on your left-hand side. Mortgage burdens has been always a big part of the household debts, and mortgage payments can actually eat up half of your disposable income or even more. So imagine that you are just a normal office worker and you're servicing your mortgage payments on homes in stalled housing projects that you wouldn't even know when will you get your house. So if you are in this situation, will you also be inclined to stop your mortgage payment as well? So the other chart here shows that the boycotted loans as the percentage of mortgage loans. Although the Bank of Nanjing has the highest percentage among its peers, the number of involved in these boycotts are too small to matter now. However, looking beyond the impact of the bank's loan books, that we think the impact is minimal. We think that the bigger underlying problem here is that how bad will it hurt consumer confidence? So as mentioned, the mortgage boycott crisis does not just hurt bank loans book. It will indirectly affect the entire economy if it is not contained properly. So some implications of the poor consumer confidence is that people stop spending money on property. So as shown in this chart on the left-hand side, Chinese developers posted the worst earnings season since at least 2008. So here, so does the backdrop of the property sector clampdown has gone way beyond government's expectations, and have the governments messed up? So despite government offering guarantees towards some of the upcoming onshore bond offerings, we still maintain our doubt on its effectiveness in reigniting consumer confidence. So the serious damage to consumer confidence suggests that Chinese new home sales are set for a slow L-shaped instead of a very fast V-shaped recovery. Buyers are prone to defer or even cancel their home purchase plans while investment demand is subsiding. So as you can see from this chart on your right hand side, these are some of how are the Chinese developers doing so far. So on a year-to-date basis, you can see that most of the developers are experiencing like almost more than 50% of the losses in sales growth. So despite all of the negativities surrounding the property sector, we think that the mortgage boycott will not brew into a big problem and less likely to be a long-lasting one. One of the reasons is that due to the China's social credit score system, we reckon that other home buyers facing non-delivery of their homes may not have the huge incentive to join the boycott, as those who stop their mortgage payments would suffer a hit to their social credit scores. So under China's social credit score system, each citizen is given a score based on their behavior. Their social credit score increases after performing socially desirable actions and vice versa. Citizens who have high scores can enjoy benefits including priority for employment, a cheaper public transport, and on the other hand, citizens who hold low scores can be excluded from booking flights or high-speed rail tickets, and their children could even be excluded from private schools. For example, in 2017, there are 17 people who refused to pay military service. So as a consequences, they were barred from enrolling in higher education, applying for higher school, or even continuing their tertiary studies. So no matter how serious the issue is, people wouldn't be willing to risk their child's education, right? Am I right? So furthermore, the expected potential damage to the financial system is about, on this crisis, is about 2,400 billion yuan, which is less than half of the max tolerance that would potentially spark a systematic risk. So here we would like to highlight two possible scenarios that were likely to unfold. Firstly, assuming that the financial institution and government work hand in hand in assisting developers, the extent of the issue could end up in a low end with around 50% of the houses to deliver between 2021 and 2022 have failed, which cost around 1.6 trillion yuan of boycott loans, affecting 1.4% of the GDP. On the other side of the coin, if words speak louder than action, that is, if the Chinese authority are slow in responding to the situation, such as failing to guaranteeing bond offerings by the Chinese developers, the threat of mortgage strikes could snowball into a bigger issue, affecting around 3.8% of the GDP as estimated by Bloomberg. So as mentioned earlier, we think that the issue of mortgage boycott will not brew into a major issue, and soon people will start buying properties again, and we will expect to see a revival in consumer confidence also. The reason is that, first of all, the 1 year and 5 year LPR are down like historical lows. Just a few weeks ago, the PBOC has cut its 5-year loan prime rate and the main benchmark rate for the home mortgage in China for the second time this year by 15 basis points. This was the biggest reduction since China revamped its interest rate mechanism in 2019. So the drop in mortgage rates, in conjunction with a series of other policies such as lowering down of the down payment ratios and the relaxation of purchase and lending restrictions, sales of commercial properties were significantly boosted during both periods, as shown in the graph on the right hand side. Inside the box were the low interest rate period for China. So next, the average property prices has declined by 12% in Shanghai in just 1 month period, and governments are guaranteeing some of the developers with strong financial position. Beside, the yield spreads chart on the right-hand side shows that China property sector high-yield bonds is trading at close to around 18% premium of from the US Treasury yields. With that, we think that cheaper property prices that can be financed at a low rate with guarantee will attract more home buyers to come in soon. Regardless, we still expect to see weaker developers to continue to struggle and might see a further default on bond payments. But we think that the cleanup in property sector will soon end, with home buyers flock towards more healthy and good developers. With that, we think that the Chinese property sector is not all gloom and doom, and it's set for a potential recovery. Thus, we change our stance on the Asia high yield, which has high exposure towards Chinese property sector from underweight towards neutral. Until here, I hope that I have cleared some of your doubts on the Chinese property sector. So until now, we also knew that China is unlikely to budge from its zero COVID strategy, despite the official rhetoric that the government that will not change its zero COVID policy. China has been adjusting and softening its stance since 2021, moving subtly from a strict approach to a pursuit zero infections towards now they call a dynamic zero policy approach. So, which is a less restrictive approach that aims to contain outbreak in the shortest time possible. So in recent times, China has also taken steps to ease its COVID-19 restriction. Not only did it reduce quarantine times for inbound travelers by half, China has also shortened the length of suspensions for inbound airline flights that carry passengers infected with COVID-19. Also, they are also allowing some of the overseas students to come back to China's study I think recently also, yeah. So with while the spontaneous lockdown in IKEA store in Shanghai was certainly extreme, we note that mobility in Shanghai has not been significantly curtailed, with public transport still up and running as shown in the chart on the right-hand side. Moreover, we believe that the investors may have been too pessimistic on the earnings outlook for Chinese companies, with the earnings estimates for MSCI China Index in 2022 has already been slashed by around 16% this year. This is in stark contrast with the US equity, where earnings estimates for S&P 500 index has seen upward revision this year despite mounting macroeconomic risks. So as such, we believe that the risk in China equity market has largely been discounted by markets, and there is scope for the earnings to surprise from here. At this point, sentiment towards Chinese equity is one of the extreme pessimism, with investors trying to look beyond Chinese present headwinds and just want nothing to do with China anymore. This is a sign that market is not too far from the bottom, as I would like to quote a famous quote from Warren Buffett, be greedy when others are fearful and be fearful when others are greedy. So valuations for Chinese equities remain undemanding and look attractive. With the MSCI China Index having fallen to multi-year lows, the MSCI China Index is trading at a P/E ratio of 8.9 times the 2024 earnings. Applying our designated fair P/E ratio of 14.5 times on the EPS projection for the next 2 years, we arrive at a upside potential of 63% over the next 2 years. Next, let us look at a major sector in China that has kind of gone off the hook for investors' preference after all the new policies and regulatory crackdown. And that is nonetheless from the technology sector, which represented by the Hang Seng Tech Index. We think that it is not game over yet for the industry, and still a lot of opportunities for capital gain. So 2021 and 2022 was a really tough year for Chinese tech stocks. The Hang Seng Tech Index is down by 27% year to date and down by 62% since its peak in February 2021. Since the beginning of 2021, the increase in stamp duty causes a massive sell-off, especially in the H shares. From July 2021, the regulatory authorities have successively issued new regulations aiming at China tech giants. So moving into 2022, despite less regulatory crackdown targeting the tech sector, we see little to no improvement at all. So while Chinese tech companies still struggling to recoup their losses from last year's regulatory crackdown, China's zero COVID policy has added wounds to the already beaten up sector. Chinese tech giants has had their worst quarterly growth on record. And one recent example is just yesterday, the lockdown has caught in the area for where the battery manufacturer CATL is. So in the second quarter of the year, e-commerce firm Alibaba posted its first ever year-on-year quarterly revenue growth, and social media gaming company Tencent reported its first sales decline on record. So JD.com is also, which is the China's second largest e-commerce player, also posted its slowest revenue growth in the history, while electric maker XPeng also posted a wider than expected losses, as well as a weaker guidance. So on top of that, recently, US banned NVIDIA's AI's computing chips export to China on fears over that China-related policies. The impact is significant, as without American chips from companies such as NVIDIA and AMD, Chinese organizations will be unable to cost-effectively carry out kind of advanced computing used for image and speech recognition, as well as among other tasks. So this slide shows the new policies and regulations by the Chinese authorities starting from July 2021, targeting at the internet, education, and gaming industry, which caused a massive sell-off in the market. So China tech giants enjoyed a boom during the pandemic as people turned online services such as shopping and gaming amid lockdowns, and that has made the year-to-year performance comparison even harder. So now the Chinese economy is facing a number of headwinds this year that has made the macro environment look even tougher. So when we look at the 30 constituent of the Hang Seng Tech Index, we find that the sell down in the individual stocks are far larger than the index, and among them, over half of the components have lost more than 30% year to date. Some companies such as Bilibili, XPeng, Sunny Optical, Xiaomi have even plunged by around 65%, 59%, and 43% respectively. So China's economy grew just like 0.4% in the second quarter, and that impacted the strength of the consumer as well as spending from the companies in areas such as advertising and also cloud computing. So next, we would like to look at some of the spillover effects of the technology crackdown. When Xi Jinping tightened the screws of the China's technology industry last year, he escalated a job crisis for the youth, with the tech sector no longer offering them such lucrative and exciting career path as they once did. Many will join the jobless ranks in China, and now we have 1 out of 5 people between the ages of 16 to 24 are already out of work. And also, most of the China tech giant techs have experienced a mass layoff, and the youth between the age of 16 and 24 were one of the major victims, as they are considered to be the most inexperienced one in the workforce. So despite lower population unemployment rate, the 20% of record youth unemployment rate, which is almost 4 times of the national urban rate, is a scar towards the economy and a setback towards the Communist Party before the major congress that sets to usher President Xi Jinping into a precedented-defying third term. So this sparked the question again, the question of, has the Chinese government messed up in failing to assess the risk, and has they gone too beyond? So while China tech sector has witnessed difficult times in recently, we do believe that there is a turnaround side for the sector. The market has seen a policy bottom. Since 16 March, multiple departments have jointly issued relevant statements on maintaining the healthy and stable development of the financial market and preventing the occurrence of systematic financial risk. And among them, the statements such as actively introducing policies favorable to the market, encouraging and welcoming long-term investment, encouraging corporate to repurchase, and supporting the healthy and stable development of Hong Kong financial market were mentioned many, many times. So with Chinese authorities now openly displaying support towards the development of the market in such a manner, we believe that the policy bottom is near. Meanwhile, just 2 weeks ago, Washington and Beijing have reached an agreement which allows US auditors to inspect China-based accountants. And this is a very good step, as it is the first step in a process that it could prevent around 200 Chinese companies that is listed in US being kicked out of the American stock exchanges. So based on this news, we expect market sentiment to keep improving, which will provide support towards the Hong Kong stock market, especially for the tech sector. So next, the corporate buyback boom. Most companies have announced repurchase plans after July last year and have also increased their buyback plans recently. One of the reasons why companies buying back shares is that companies themselves think that their shares are trading at very reasonable prices, since no one else understands the company more than they do. So often it is a very good indicator. So the third factor is that we think that the earnings estimate has reached its bottom. So the downgrade of earnings estimate has reached its bottom. So as you can see from the chart, earnings estimates for the Hang Seng Tech Index has been flat for a few months, showing signs that analysts stopped downgrading their earnings estimates for the China technology sector. And if you look closely here, there is also some upward revision of earnings estimate recently, showing a turn of view towards a more optimistic stance. So as shown earlier, the earnings estimates for the Hang Seng Tech Index has been on a downward trajectory entering into 2022. However, from this chart, we can see that the price earnings ratio has also been in a declining trend, showing that the plunge in prices are far more steeper than the downward revision in earnings estimates. Currently, it is trading at below 1 standard deviation away from its mean, the yellow line, showing that the prices are in great discount. So the Hang Seng Tech Index is currently trading at a PE ratio of 15 times the 2024 earnings. By applying our fair PE ratio of 30 times based on the EPS projection for the next 2 years, we project around 100% upside potential for the next 2 years. As you may notice earlier, the earnings estimate per share has been downgraded significantly here from 422 in 2021 to 154 in 2022. So we think that the earnings downgrade has provided rooms for earnings surprises. So as shown in this chart, on your left-hand side, almost all of the companies in the Bloomberg survey has reported earnings surprise so far in the second quarter of 2022, meaning that their earnings has surpassed analyst estimates. So the average earnings surprise in the second quarter is 38%. So by putting everything together, we believe that there are compelling reasons to be optimistic on the Chinese equities, with a lot of negativities already priced in the market. A further easing of regulatory pressures and also a policy backdrop that still remains accommodative means that there is scope for Chinese equities to outperform. So for investors who seek exposure towards the Chinese equity market can consider the RHB Big Cap China Enterprise Fund. So the RHB Big Cap China Enterprise Fund is our recommended unit trust fund and they have been experienced success delivering stellar performance as they outperform the benchmark MSCI China Index for almost every year since after 2018. So the fund invests a majority of its funds of its NAV in H shares and some in A shares. They have heavy exposure towards the technology-related companies. As you can see, their top holdings were Alibaba, Tencent, NetEase, Meituan, and JD.com. So if investors prefer some exposure into the Greater China, they can consider our other recommended unit trust fund, the Principal Greater China Equity Fund, who has been delivering outstanding performance over its benchmark MSCI Golden Dragon Index since 2017. So similarly to the previous fund, this fund have heavy exposure towards technology-related sectors. However, the different thing that is that they have exposure towards countries outside of China and Hong Kong. As you can see from the regional allocation, they also have Taiwan, 12%, and also Australia in their regional allocation. I know that most of you, some of you have some understanding on the Taiwan Semiconductor Manufacturing Company, the TSMC, which is the largest semicon manufacturing right now. So this fund has about 10% of its NAV allocated in this company as of 31st of July, allowing investors to benefit from the rise of the semiconductors. So for investors who seek opportunities in the China A shares, they can consider investing in the M China A shares by M funds. This is a feeder fund that invests in the Allianz China A shares. So please be aware that this is also a wholesale fund. So yeah. So similarly, it has outperformed the benchmark almost all the period. Notably, the fund also recorded a positive return in 2021, which is when most China funds are experiencing a drawdown. So this fund captures large to mid-cap representation across China's securities. Therefore, you will see a divergence between the top holdings of the funds compared to other China funds that gives the fund manager room for generating alpha through stock selection. Aside from the unit trust funds, investors can consider investing in our ETF focused ETF list. We have the iShares Core MSCI China ETF that tracks the MSCI China index. So as you can see from here, their top holdings were a lot of technology names also, but they do have other like communications, financial names. And so the technology names such as their top holdings are like Tencent, Alibaba, Meituan, China Construction Bank, JD.com, NetEase, and Baidu. So meanwhile, if investors are keen to have exposure only in the China technology space, they can consider our other focus ETF list, which is the China Hang Seng, the iShares Hang Seng Technology ETF that tracks the Hang Seng Tech Index. So yeah, as you can see, all the top holdings, all the holdings in this fund were basically technology names. So here are some key takeaways for the session as you all can have a look. Aside from all the data and graphs that I've shared, let me give a closing speech that I hope it could comfort you. I think China is presenting a very good opportunity. It's currently trading at like 2018 levels. I know many of you has been listening to that follow us has been listening to us talking about China over and over again since last year, and many of you are still worrying about topping up or even enter the market over fears that this might be the end for China. I can't deny that China is currently trading in an inevitable slowdown, and all the regulatory crackdowns has placed the economy in a very bad shape. But I don't think that this is the end for China, because who are we talking about now? We're talking about the second largest economy in terms of GDP in the entire world, and soon they are going to surpass US. So for China to end, we need to see something fundamentally change in the economy from good to bad. But no, what we are seeing right now from the Chinese government is that they are trying to reshape the economy, and the fundamentals are still there. So in my opinion, all the regulatory crackdowns and a cleanup in the property sector, it's a pain process, no doubt, but it is the right thing to do. Because all of you also know that China has been one of the fastest growing economy in the entire world. And what does the history teaches us about growing too fast is that it will create a bubble. And all the things that we are seeing right now from the Chinese government is that they are trying to, with all the policies, all the regulatory crackdowns, is that they are trying to prevent companies from getting too big to fail. They are bursting the bubble before it gets too big. So a big example here we have that I have is Japan, who experienced a pop in its asset price bubble in 1991, and after 2 decades until today, the economy still struggles to recover from the losses, and this is very terrible. And some of many people also refer to this as the lost decades for Japan. So China is trying to avoid repeating Japan's mistake. They are currently sacrificing short-term pains for the economy to grow in a healthy and a sustainable pace. So in conclusion, although we cannot deny that there is still headwinds for the economy, we think that the risk is worth taking by cautiously selecting companies that have strong financial position and a good business model. If you do not have time to filter all this and or to do all the research and filter all the companies that has good, strong financial position and good business model, you can consider to leverage our existing fund managers' expertise by investing in our funds, such as the RHB Big Cap China Enterprise. So that's all for today's session. I hope you get something fruitful today. Let's move on to the Q&A session. Yeah, so one of the questions here we got is China's zero COVID lockdown is causing disruptions to many supplier chain, and how can China economy recover as long as COVID is here to stay? So as I mentioned earlier, China, yes, with all the policy, with all this COVID zero policy, the economy has taken a very hard hitting, but we are seeing that the government is actually the situation is actually improving, and the government is switching towards a more dynamic zero policy by reducing quarantine times, by the lockdowns. They doesn't target the whole city, they just target areas that has the highest infection. So they are still improving, and also just recently they let foreign students, overseas students, to come back study in China, also limit but still it's a sign that the government is gradually improving this situation. Yeah, and I hope that answer your question. So any recommended fund for the ETF Hang Seng Tech is that we have the MSCI, the iShares MSCI, the iShares Hang Seng Technology Index as shown, and this is it. Yeah, iShares Hang Seng Tech ETF for the China technologies stocks. Yeah. And we have another question saying that is there any ETF specific to China EV stocks? Yes, we do currently have one in our platform. It's called the Nico M Straits Trading Future Mobility ETF. You can find it in our platform. So this ETF has covered the entire supply chain of the EV industry in China. So from they have from the downstream, from upstream they have the commodity sourcing company, and midstream they have the battery maker such as CATL, and downstream they have the EV car manufacturer and dealer, the NIO, such as NIO, yeah, and other companies. Okay, so I hope that answers your question too. So how badly is the mortgage boycott affecting the state-owned banks like ICBC and CCB? You can refer to this chart. Wait. So yeah, here you can see that ICBC here is also here. Yeah, ICBC is here. So it's the impact, as I said, it's very minimal. And to CC Bank is the China CITIC Bank is even minimal. So I don't think that this will bring into a big problem that affect the bank's loan books yet. So the major issue is still the consumer confidence that will affect loan growth and even the property sales also. Yeah, that's a major issue. Let's take a look at what are the other questions that we have currently. We have one interesting one is about, is US tech more attractive than the Chinese tech? I think that the US tech and China tech is like apple and orange, that you can't really compare it side by side, and both has its own pros as well as its cons. So US technology stocks may look appealing as they are free from like regulatory risk from the governments, while China techs are trading at super low valuation, and thus they have very attractive upside potential, but also they do have a higher downside risk. So eventually, it all depends on your risk, your preference, and your risk appetite. So yeah. So one other question is there any opinion on how long will the China market recovery? So yeah, we think that we are seeing a policy bottom with all the supportive policy already in line. The Chinese government is actually playing a waiting game and waiting for the market to, the sentiment to rebound, to consumer confidence to rebound. However, we do like to urge investors to not time the market and stay invested as long as I would like to use a quote from the great Peter Lynch. Far more money has been lost by investors preparing for a correction or trying to anticipate correction than has been lost in the correction themselves. So we continue to promote diversification in the portfolio to help you navigate through tough times. So we have one. Is it better to look at ADRs now or Hong Kong China listed funds? I think that if you look at ADRs, they have a higher risk of the foreign government risk. But if you straight away buy companies that listed in Hong Kong or China, they don't have this problem. So yeah, it's much more better. It's depend on you. So another one we have is how will the weakening of Chinese yuan impact China? So the weakening of China yuan will boost China export as well as to make their goods more competitive in the international markets. However, China will will also suffer from expensive imports as they are the largest importer of crude oil. So the Chinese government has been trying to stabilize a weakening yuan by setting a stronger than expected exchange rate, fixing at uh, 10 straight day of 6.91 yuan per dollar recently, and said that it will allow banks to hold less foreign currency in reserves to around like 6%, which will effectively increase the supply of dollars and other currencies onshore and weakening their currencies respectively. Yeah. So here we have what are the recommended China funds. As mentioned earlier just now, you can find our recommended funds for China, such as RHB Big Cap China Enterprise Fund, which invests in H shares and A shares. We also have the Principal Greater China Equity Fund. The difference is that they have exposure towards companies outside of just China. They have Taiwan and also some companies in Australia that generates most of their revenue from China. Yeah. So we also have this M China A shares, who is only invested in A shares, but only invested in A shares, but it's only for wholesale investors. So let me see what are the other questions inside. I think that's all. We have one here is that does Alibaba book still looks healthy, still healthy given by recent financial reports show no revenue growth? we think that yes, of course there are some headwinds facing Alibaba, but if you see Alibaba, they are keep innovating, they are keep trying new things to expand into new territories. So I don't think there is a limit to their growth, and the slowdown in growth will not sustain, and soon you will see some good growth coming soon. And also there are rumors that the China government is actually considering in letting the N to listed in China. So yeah, lor. So I think is we don't see that there are a lot of there are still headwinds, but we don't see that this is how far they will go. Yeah. Any fund that don't have Alibaba on and Tencent, because most of the fund that we have right now has exposure towards Alibaba and Tencent because they are considered to be the large caps of China, and also they have very good growth. So a fund that you may consider that might not have but right now doesn't have the Alibaba and Tencent in their top holdings is the M China A shares, which exposure towards large to mid cap. So they have the ability to switch between a lot of stocks. So you can see their top holdings, they don't have any Alibaba or Tencent. Yeah, but be in mind that this is a wholesale fund. Yeah, thank you. Okay, so I guess that's all for today's session. I hope you get something fruitful, and I hope to see you all very soon. Thank you.